Upstart Holdings Inc. is falling in after hours. It is down from $77.13 to $45.85. That is about 41% down in the last 20 minutes. They have just released their earnings for the first quarter of 2022 and the market is not too pleased. So what I'm going to be going to do today is looking through these latest earnings and then putting these in my discounted free cash flow model and my Buffett-Graham intrinsic value model to see if this stock is a buy. Should you be buying the dip? This dip is a hell of a dip. So let's just quickly go through the stock price over the last year. It's actually down only 12%. It was at highs of around about $390 a share and has down 80% and is in fact down a heck of a lot more because it's now at $44 a share. So this stock is down massively. Is this the right time to buy? Well, I might have some surprising answers later in the video. So let's just touch on some of the highlights here. Revenue. This is the highlights that they have here. Revenue was $310 million, 156% increase of the first quarter. You can see that the transaction rate is up to 465 loans, totaling 4.5 billion. Income from operations is up 34.8 million compared to 15.6. EBITDA up, contribution profit is up, and in their outlook as well, they're expecting increasing revenue, net income to actually a negative to positive, so that is a good sign, and they are going to increasing the shares. We'll be talking about that in a minute. So let's get into the numbers. We will just quickly scroll down the bottom of the video, the financial statements here, but first can you please give a like on the video? It really helps me out, and subscribe if you're not already. So let's get into it. So firstly, what has happened with revenue? Well, we have the 3 months ended on the left of 2021 and then the 3 months ended on the right, which is the most up-to-date numbers. So what has happened with the revenue? Well, as you can see, revenue has increased from 121 million to 310. So that is definitely positive there. And if we look at Yahoo Finance, the revenue has been increasing 95, 162, 222, and 846 million. And with these latest revenues for the quarter, the trailing 12 months is $1 billion, $1 billion and 35 million to be exact. So revenue is up, very, very promising. What we do with that revenue? Well, next thing we need to be looking at is the net income. How do we get net income? Revenue minus expenses. Net income is actually up 10 million to 32.6. So if we look at the previous years, you can see that net income has steadily increased at minus 12 million, 3.8, 0 in 2020, 135 million in its most recent year. And if we take in the most recent Q1, the trailing 12 months for the profit is 158 million. So profit is also up. Revenue and profit are up. You wouldn't expect this stock to drop 41% in after hours trading, but here we are. So next, what's happening here? We want to look at the shares outstanding. Upstart are really diluting their shareholders. They're 73.6 million shares to 84.2. So they are massively increasing shares. Now, if they were increasing shares at this point here, that was obviously good for the company because the share price has dropped massively since then. But the share price is down pretty low at the minute relative to where it was. So maybe not the best time to be doing it. But actually, it was a good time to do it because they did it in this quarter. The share price is pretty much halved since then. So in hindsight, not bad that they did it. Right, next we're going to be looking at the free cash flow. So what we need to do is go to the cash flow statement. How do we get free cash flow? Well, it's cash from operating activities minus capital expenditure. So let's have a look at that here. Well, how do we get net cash flow? Here it is here. Net cash from operating activities minus capex, and the net cash flow has gone from 43 million to minus 266. So that is a massive, massive, massive decrease, which is probably part of why this has gone down. Free cash flow based on these numbers, if we do free cash flow, which is 266. Take away the capital expenditures, which were on here before. I think they just had just over 1.6 billion. So overall, that puts the free cash flow from the year down quite massively. If I just bring up my calculations here, we can see that free cash flow has gone from, let's go to Yahoo Finance quickly. Go to the cash flow section. So 49 million, 26 million, 10 and 153 million. But unfortunately, with this massive, massive loss, that actually puts us at, oh, I have not had the calculation. Well, let's find out what this is right now. If I go back to the sheet on this page here, we have 226 million to the negative. So let me just add that into my sheet now. 226, 7, and 5. We won't take away the thing. That puts the free cash flow for the year negative on the trailing 12 months, 156 million in the negative, which is obviously a massive decrease to what the stock was previously doing. I don't know why we're on Visa right now. I think that's I must have accidentally clicked it. So let's have a look at that. So as we saw, the financials on the free cash flow looking good. Probably going to be a good candidate for the discounted free cash flow model, but right now they're in the negative, so not looking good at all. Yep, you can see we were positive, trailing in the right direction, but now it has gone pretty bad. So let's have a little deeper look into the numbers and see what that is, see what's changed from this year to last. Well, let's have a look at, obviously net income was up. What are the biggest things? Well, you can see that loan service agreement net, that was a big increase. Stocks-based compensation is up. Yep, loans here, a lot of issues with the loans, and overall that is why we have this in the negative right now. So free cash flow not looking good, and if we go to our cash flow statement here, this will probably be not looking good as well. We've calculated the future free cash flows based on some averages. Now this is estimating positive free cash flow in 2023 and steadily increasing. So let's see what that gives us for Upstart. Says the stock is at $47 a share, which at the point of this creation was a 38% discount, but the share price is currently below that. So based on increasing free cash flow, the stock is a buy, but we really need to look at these numbers and sort of take them as an average now because of this massive decrease. So the average of this would be 61. The averages of these, I don't think 20%. Analysts are expecting good growth in the future, which is quite a good thing, but let's just go a little bit more conservative here and take that down to 18%. What does that put us at? $40 a share, but this is still positive free cash flow in the future years. So they really need to turn that around. And then finally, the Buffett-Graham intrinsic value model. It takes earnings per share, expected growth rate, and bond yield into account. Well, interestingly enough, the earnings per share is positive because if we go back to the cash flow statement, the financial statements here, you can see that net income is positive, which is obviously good. So what does that mean for the stock price and the Buffett-Graham intrinsic value? Has a fair value of $110 a share. So I've never actually seen quite a disparity like this. This is saying it's a massive buy based on Buffett-Graham intrinsic value. It's not a buy based on discounted free cash flow. Market has reacted very poorly to this. So this could be a good opportunity to jump in on the stock. Personally, I would not. But if you take the price somewhere in the middle, this does look like a buy based on the models, though I would disagree with them this time. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if not already, and I'll catch you guys next time.